Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, January 6, 2021. In this video, I want to do an update on the markets. I want to cover some of the things that I've highlighted recently and a few other things that I haven't. So we're going to primarily focus on the broad markets, although there's some somewhat related things that I'd like to touch on as well. In fact, this is the second draft of the video. There's so much I want to cover. I was doing this video, I did it earlier and scrapped it after 30 something minutes. It was just going on too long. So I'm going to try to condense this, keep it relatively brief. But I think these are all important things. So there's definitely some developments in treasuries. We've broken down. Treasury bonds have broken down support. Yields have broken out. What that might mean to the stock market. I'll do a brief update on gold too. I may touch on commodities because it's all related. It's the reason the other video was going so long. I'm trying to explain that there's this huge run up in commodities, especially a lot of the ag commodities, oil and gas are going up, and that is definitely inflationary, and I think that may play into what's going on with treasuries right now. But again, let's start here. Let's start with the stock market. We'll work our way into there. I will most likely do a separate update, a more comprehensive dive down into the commodities. I've been highlighting those as some of my favorite trade ideas for actually for quite a while now, since last year. And oil, gas, coal, a lot of other things like that. If time permitting, I'll touch on those too in another video. Okay, so what's happened recently? We had sell signals. Just to recap, I do these recaps because I realize every now and then I'll get a question on the site, something that I recently covered. I know that some of you listen to my voice are actively trading and investing all the time, watching these videos. Other people come in from time to time and check out what's going on here. So let me highlight this. Recently we had sell signals, and they were pretty convincing. They were impulsive. We broke the primary uptrend line that's off the November 2nd lows right here in QQQ, this white trend line, followed by a break of my secondary trend line that comes off these lows about the 9th or 10th of November. Quite a few reactions. So that's what I was looking for a sell signal on the Qs. Now, a couple things. It came on the first trading day of the year, so for that you take it with a little bit of grain of salt. Anything trading around the holidays, low volume, and whipsaws are more likely to occur, in the last few weeks of December and first trading day of the year in January. But that being said, they were sell signals, and they still are. They're still intact. In fact, we're still below where the first trend line broke down, and we're right now trading right about where the second trend line broke down, right there. So you can see when I put the horizontal line on the crosshairs. So the sell signals are intact, but again, these were sell signals on a 60-minute time frame. We need to see, to really firm up the case for more downside, for a swing short trade, we need to see the lows from Mondays get taken out on both QQQ and SPY. So that's yet to happen. And if that happens, the reason I'm looking for that is it will confirm what our potential topping candlesticks. That's the bearish engulfing candles that we put in on Monday. You want to see a bearish engulfing candle come at the end of an extended uptrend. That's by definition their potential reversal or topping candlesticks. And what I'm referring to, if you're not familiar with what that is, always any of these terms I throw out, I try to explain them, but if I don't, just do a Google search for bearish engulfing candlestick and you'll see, the body of the candle, this fat part, needs to engulf the previous candle or more. In this case, we engulfed actually, we may have come back in and engulfed these, but we engulfed at least the previous 4 trading sessions. Now, I've always added, I don't know, depending on what hit you get, what Google result you get, and what site you get taken to, I've always said I like to see confirmation with additional red candles. That doesn't mean one green candle negates the signal. What negates the signal is when we move back above the bearish engulfing candle, because by definition that wouldn't be a topping candle if you go back above it, because then you have a new high higher up. So bearish engulfing candle must come. It must come at the highs and then be confirmed with additional red candles. And as I was saying the other day, I want to see a close down below Monday's lows. So that hasn't happened yet. We didn't even take out the lows on an intraday period. So this is a daily chart. Now, again, the sell signal is still intact. There's the November 2nd low. Here's that trend line shown on the daily chart. There's a breakdown candle, and so far we're moving lower. So the potential is still there. Just because we haven't taken out those lows yet doesn't mean that the sell signal has been negated. Again, it'll be negated if and when we move over the top of that bearish engulfing candle. SPY has come close. In fact, SPY popped above it briefly today, but so close. If you're splitting hairs, the body of that candle, you can see pretty much they're right about even right now. So the S&P 500 has been a little bit stronger, but same story. Really, I don't want to say put the nail in the coffin, but to give me a lot of confidence that we're going to drop. And I'm talking probably a good double-digit correction, if not more. We need to take out Monday's lows, and you can see quite a bit of work to be done. The S&P 500 is outperforming the NASDAQ 100. You can spin that as positive. If I want to play that game, be the glass half full guy, optimist, I'll say, look, I have to. One thing I'll give this rally credit on is its broad-based participation. Market breadth has been good. A lot of sectors participating, a lot of stocks participating. If I want to play devil's advocate, I don't know if you can see it over here. I think I can move the screen over and show you. To the right here, it's the market leading FANGs. You can see these are the top holdings in the S&P 500 as well as the NASDAQ 100, and look at them all. These are your market leaders, have been for many years, have been throughout this bull market. Apple, Microsoft, Amazon, Alphabet, Facebook, and look, they're all down. Just about everything else is up. Tesla, of course, still strong. Tesla's going up only because there's too many damn shorts in the stock, and it's been one of the most heavily shorted stocks. And they're just getting squeezed out gradually. It's an extremely overvalued stock. You also have the Robinhood traders that really don't really understand valuations. And understand how extremely overvalued Tesla is. So there'll be a short on Tesla to come, and hopefully we'll be able to catch that. In the case of Tesla, I'm using the whole second mouse theory right now, where second mouse gets the cheese. So then what that means is you're not going to short the high. I like to catch tops and bottoms, but not on Tesla. We're going to wait to see a little bit of evidence, and when the time is right, maybe we'll jump in there. And what it's going to take, you're going to need to see most of that, or a good part of that short interest cleared out, in other words, stopped out. And so kind of in summary, the way I'm looking at, the broad market, the S&P 500 seeing that broad-based rally, but the most important stocks, these have the highest weighting by far in the NASDAQ 100, and they're also top-weighted components in the S&P 500. And there's also a psychological impact on these, these stocks have. They are the most widely held companies, around the world. And I think if you see the FANGs break down, they'll probably take the rest of the market with it. So we're not there yet. We're close. I showed you the levels to watch on both these FANGs. And again, the S&P 500 and the NASDAQ 100, which is just pretty much Monday's lows. And futures traders, we have that same uptrend line off the November 2nd lows right there, your primary uptrend line, and a nice secondary uptrend line, just like my QQQ chart. Remember QQQ yesterday pointed out as an objective short entry, and and on NASDAQ 100. Futures here, NQ, and we got a nice drop. It might have been about 2% or so, or what was it, from the back test. I think the Qs were back testing right about here. Yeah, it was better than a 2% drop overnight. And we undercut Monday's low, but this is in the Globex session. This was not, we didn't undercut it in QQQ. We need to see QQQ undercut it during the regular session, and especially a solid close there. And as I showed you, even if QQQ does it soon, S&P 500 has a little more. We'll have to play catch up to the downside because we've had a little bit better bounce in the broad market. But there it is again. Like I pointed out, if you're an active trader, you can short bounce backs to this trend line right here. And if they take it out, well, you still have the primary trend line right here, but that's a ways up there. And if they take that out, depending on if and when that trend line's back tested, we may take out the previous highs. So kind of to loop back as far as trading opportunities, what I said yesterday holds true. If you're an aggressive trader, you could have shorted there yesterday on the back test right here when it was pointed out, and I set a tight stop, a 1 to 2% stop. Remember, we're only, from that level, it was only about 1% to the highs right there. And, measuring out, that's about a 1% move. And I said you could short with a 1 to 2% stop. 2% stop would be somewhere up here if you want to give it room for a little bit of a whipsaw fake out signal. And it's all to me about risk reward. Is it the highest probability trade? No. Why? Because we haven't taken out those lows. We don't have sell signals on the daily chart. That's why. We only had these sell signals and still do on the intraday charts, the 60-minute charts. So I consider it an aggressive trade with we'll just say a lower chance of it playing out. However, I always, I'm very analytical, and the way I look at a trade is, okay, I'll take a trade with a lower chance of success if it has an above average risk reward profile. So in this case, shorting there with a 1 to 2% stop, meaning you're risking 1 to 2% to make what could potentially be 10% or more. And that to me is a very attractive risk reward. I've given you some early targets on the 60-minute chart, but on the daily chart, these are all potential targets. And let's say we move on down here, there's about a 20% drop. Down to this one here is about a 14% drop. Down to the 283 level is about a 9% drop. They're actually closer to 10 from where we back tested yesterday. Okay, so there it is. Those are my thoughts on what we need to watch for on the broad markets. Now we'll look at a couple other things. Again, this is largely a recap, but I realize there's always new folks coming to the site or those that aren't actively monitoring the markets. I just want to recap some of the things that I'm seeing. These are some of my most reliable trend indicators, or not a trend indicator, but buy and sell signals. And this is one of them here. This is a CPCE, the equity put to call ratio index. So it's measuring a ratio of put buying to call buying, and not on the indexes, just individual stocks like Apple and Tesla and Microsoft and the likes. And again, I've covered it many times, but it's worth reiterating. Here's in the last decade. We're looking at actually 2 decades here, aren't we? Yeah. You've had only a few signals, and they came right before some of the biggest drops that we've had. And this is a persistent cluster. This isn't a failed signal. These are, it's a period of persistent bullishness and multiple tags, and that can go on for some time. And again, that happens before the correction. So what'll happen is, if and when we get a big correction soon, this will start moving up, and then you'll be able to say, okay, that cluster is now finalized. It's in place. And what'll happen there is you'll start to see more and more put buying instead of call buying. This is showing an excessive amount of call buying compared to put buying. And likewise, I've gone over that these are your buy signals after corrections. You want to see a spike up to the screen zone. And the same thing with the CPC. That's the total put to call ratio index. So this includes index options and things like that. This doesn't have a perfect track record like the CPCE. Again, but there were more signals. And so here's one I pointed out where this was about the only false signal. We had a cluster readings there that wasn't followed by a correction. But other than that, the track record's pretty damn good. There's one just to the left of the chart here, caught the last bear market. This cluster proceeded 18% drop, 21% drop, 10. So these are all double-digit drops. The last one that we had that signaled a correction came right before that 36% drop into the March lows. And here we are again, persistent low readings, a cluster that's still in progress, if you will. And so that's it. And then one other one I have that has been very reliable is my low volume sell signals. This is QQQ, and I've covered this quite a bit. I have these red and yellow lines here, and what I like to use is the 10-day exponential moving average on volume. So you put a moving average on the volume, because that helps filter out little spikes. You're going to have holidays and things like that where you get low volume, so that's why I don't look at any one day, but an average of 10-day volume. And so we tag the red line there. You can see all the arrows. I won't spend too much time on it, but when volumes drop to this extreme, when the 10-day average drops here, that's where you get these corrections. You almost hit, actually you never even hit the red line there. It was close, but you didn't hit it, and it also came after a correction. So I will say that, ignore the signal if you just had a big correction. What you want to look for is after an uptrend. So here we had an extended period of low volume. The bigger the period, typically the bigger the drop, and that was at 36+% drop there into the COVID lows, I call it, back in March. And this is it. Here's our first signal, and we're still there. We're running at this low volume. We're running on that red line. So again, some of the most accurate sell signals that I have, and this is not just like the CPC, the put to call ratio index. I say this time and time again, very important. These are not timing indicators. It's more showing market conditions, and it takes time to play out. Again, you can have these signals trigger for a month or more of low volume or those persistent low readings on the CPC. Sometimes it is a one and done. And usually when it's a brief one and done signal, it's a minor correction. The bigger that signal, the longer it's triggered, usually the bigger the drop, just like back here. And there was a one and done, boom, and here we are. We're in this. Now this can either continue for a while, or it could play out anytime now. And again, so where's the value if it's not a timing indicator? Well, back to where we started the video, right there. Break of 364 on SPY, and a break of what is Monday's low, especially a close below there, 305.18 on QQQ. That's your sell signal. And I want to add that there've been a lot of sell signals along the way here in recent months, little minor trend line breaks, I don't know if you can see a little trend line there, minor trend line breaks, little sell signals. But everything I just spent talking about, the extremes on the put to call ratio, the extremes on the low volume signals, sets a stage for a larger drop. And that's why I'm not looking for a 5 to 7 or 3 to 5, 7% pullback this time around if we get these signals. I think there's a potential for a much bigger drop. And finally, one other one I want to show you, I haven't updated in a while, is the VIX. The VIX is, when you look at the chart, this is a daily chart of the VIX, we're at support. The VIX over the years will trade. It has different support zones. You can see as I roll back in time here, we go back into, all the way back here, 2015. At this point right here, the VIX reached its lowest level ever. This was the low end of the VIX. It had never gotten that low, and so that was our low end of the range. It was support. But up until then, and if I could roll back, I can't roll back any farther on this daily chart here, but this has been for a while the support zone, and then it became support again. So other than this period of extreme low volatility heading into from 2017 to 2018, this has been a bit major support zone for the VIX. But there are times then it moves up, and lately, for a while now, since early 2020, this has been support at the bottom of this gap support zone. So I'm going to roll forward now. So the VIX is at support, or recently hit support. And what I wanted to show you here is, I'm going to turn off all the lines. Well, I want to show you first of all, the VIX works a lot like the S&P 500 and NASDAQ 100 100 in reverse, whereas you get positive divergence on the VIX before a rally, you get negative divergence on the indexes. And so you can see these divergent lows in the VIX will help predict when the VIX is going to rise or rally, and the VIX rallies when the stock market corrects. And like I always say, divergences are not a buy or sell signal. What is a buy signal in the VIX are breaks of resistance, trend lines. So there was a buy signal, broke out, back tested, boom. That was one of the biggest drop. There was your drop into the COVID lows, completely predicted by the VIX. Again, this chart was shared at the time. Back here, you had one of the biggest corrections since, and again, predicted by the VIX. We had a nice, clean, bullish falling wedge pattern with positive divergence. What's happened since then? Just like the stock market, the divergence has only grown larger. It's extended. So you still have, we're coming off a divergent low. And then finally, here's what I wanted to show you. I'm going to turn off all the lines here. We're going to compare to the S&P 500 and your SPY, purple line. Okay, now what you'll notice is the VIX will tend to fall when the stock market is rallying. It only makes sense. Volatility is falling. And the VIX is also, the methodology of the VIX. They use a measure of puts and calls, similar to the put to call ratio I gave you there, but a little bit different. You can look up the methodology on how it's calculated. But what I've always noticed is quite often before a big drop. Let me just mark the major peaks in the S&P 500. Again, the purple line is SPY. And we haven't had a lot. We had this big drop back in 2020. And I can roll it back further. But what you'll notice is, when the market's rallying like this, the VIX is falling, right? But then all of a sudden, the VIX bottoms and starts to climb right before a correction, climbing with the market. Whether that's smart money moving into more puts or who knows, that is something to look for. So again, rally mode, but then all of a sudden, just shortly before, the spike happened once the drop started, but there was a climb. In fact, right there from the low, we can see the VIX starting to climb before that drop. And here's what I wanted to point out. The VIX has been climbing recently. All along, since this peak, it was falling, falling, falling. That's where the bulk of the rally took place. So here's the end of the day. I think, the most of this rally has already been, is over with. You see the VIX has been rising, and that is usually something that happens before major drops. Here's one more. I rolled it back to 2018 right here. Your peak right there in the S&P 500, and look what happened right before that. Here is the VIX bottoming and starting to rally off the lows. And so the VIX has, in this case, you can see some predictive value in and here's another case right there. Again, you can keep rolling back and do this on your own charts. There's the peak in the S&P 500 right before big correction. There's the bottom in the VIX, and it rallied up to that, preceding that. So that's what we're seeing right now, is the VIX climbing along with the stock market. Okay, enough on the stock market. And for those of you that, saying, Randy, well, yeah, but the market keeps going up. Look, I acknowledge that, and again, we don't have we had those sell signals on the intraday charts that certainly warrant, I think, a starter position. But until I go to a full short position, I want to see those lows taken out. I want to see a little more evidence. And then as far as targets go, I showed you on the QQQ daily chart some potential targets, and I'll tell you, with everything that I've just spent 20 minutes covering on the broad markets, those extremes and the put to call ratio. The extreme low volume signals, again, the potential is there for an above average correction, not just another 5-7% pullback. And I'm saying that for those of wondering, okay, let's say, all right, Randy, I think if you get these sell signals, I'm going to jump in on a QQQ or SPY short. It just goes to help determine, hey, do I want to make this a quick in and out swing trade and cover at the first target, or do I want to maybe hold out and try to hit a triple or a home run instead of just a single? During uptrends, when you're in a good uptrend and you get a little 60-minute sell signal, nothing on the daily charts, those are good for your 3, 4, 5, 6% pullback. If you trade the NQ futures, 3% is going to put thousands of dollars in your pocket for each contract, so it's well worth it. Even 1%, is going to put well over $1,000 in your pocket. All right, now let's talk Treasuries. Treasuries, I'm going to add a line here I used to have on TYX. These are the Treasury yields right here. This is the 30-year bond yield, and we've broken out. Now remember, what my expectation was, and still is, if we get that correction, is that we break down on yields. And remember, Treasury yields move opposite bonds. These are what the yield is, what the bond is paying. So when yields are going up, bond prices are going down. And this is a breakout. I'm going to tell you, it looks legitimate. It is. It's impulsive. We gapped up. This is one of the biggest moves for a while in TYX. The yield. We took out both the horizontal price resistance at about 1766 right there. And we took out a long-term downtrend line right here. You can see this trend line comes off the highs back in 2018 right there. So by all accounts, this is bullish for yields, bearish for bond prices, and that does not mesh with the stock market. But with what stock market correction. But what it does mesh with is the fact that this could set the stage for a much larger drop. This is showing me that institutions right now are not fearful. They are exiting Treasury bonds. That's why yields are going up. I'll cover the bond prices in just a second. And if that's the case, and we already know the put to call ratio is very low, there's not a lot of downside protection in this market. This is telling me that institutions, again, they're not protected if they're selling treasuries right now. And should the markets break down, I made the same prediction back in 2018. We had that huge drop in the fourth quarter that just about nobody saw coming. And I made the same prediction back then because of those same conditions, and we had a meltdown, if you recall, back in in the fourth quarter of 2018, and that is because institutions, and it later came out in the headlines, they were scrambling, weren't positioned for that. They were overly bullish without a lot of downside protection, meaning puts against their equity positions or treasury bonds. So that's what we saw. We saw a huge rally in treasuries as they scrambled to sell off their equities to reduce their risk exposure, and the VIX exploded and everything else. So where I'm going is this is probably going to prove to be a false breakout if we get those sell signals I just talked about in the equity markets. Now, a breakout is a breakout unless it fails. Let me just say that. So here's our breakout candle. To fail, we have to first move back below that 1766 and take out this uptrend line right here. That would be very bearish. And at the same time, you can see they all come in together. You would also then fall back below the uptrend line. So if this happens, I think it is, again, setting the stage for a one of those waterfall type sell-offs. They're very lucrative. I love trading those if you can get them. And it's been a long time coming. And showing you what needs to happen. We've been in an uptrend. We haven't had any decent sell signals. And I just want to end it with this. You got to move fast if it happens, because you get in those periods where the market's falling 3, 4, 5% a day, and it does it day after day. If you wait a week, for Kramer to tell you get out of your stocks or whoever you're following, you're going to, at that point in time, miss most of the move and probably start selling your longs and going short right before the first, counter trend bounce in the correction. So that's it. So it's all set up. Okay, what else might this mean, by the way? Now this, of course, we don't have our confirming sell signals on the indexes on the daily chart, but what I think this is also telling us is the Fed they directly control the short end of the yield curve. They control the federal funds rate, which is a rate at which banks can loan money to each other to balance their reserve requirements. They do overnight loans at the federal funds rate, or they can go to the Fed at the discount window and borrow directly from the Fed. They typically don't like to do that. There's a stigma involved when a bank when they borrow directly from the Fed instead of other banks. So anywho, that's what the Fed, when you talk about the meetings of FOMC, open market committees, the meetings that they do to determine rates, that's the rate they're changing. They don't set the rate on the 30-year bond. They don't set the rate on the 10-year bond. They can certainly manipulate that market, those rates to an extent by going in and doing open market purchases and things like that. But this is largely set by the market. And when Treasury yields go up, that is typically inflationary. It's showing you market participants see higher rates coming in the future. That's why you're seeing the lift in the 30-year bond. So this breakout, and it meshes with everything that I've been saying for a while. I think the biggest risk to the stock market is inflation. The Fed, and I think they're, let me choose my words carefully. I just a little reckless in doing so, have pledged to keep rates near zero, at or near zero, for the next 3 years. Is what I'm hearing, and to me that's ridiculous. The Fed doesn't know what's going to happen between now and next month. And one thing I would know about the Fed is they are reactive, not proactive. They will flip flop on their stance from hawkish to dovish, depending on market conditions. So if you start to see runaway inflation, and that's where I'm going with this. I've talked about this extensively. Commodities, I believe, have ended a secular or cyclical bear market, and I think it's early stage bull market action. I'm looking at things like the grains I've been bullish on for a while. Wheat finally breaking out of this multi-year basing pattern, looking real strong, and some of the other grains, they're just flying. You look at corn. Corn just hit my fourth target from back here on the breakout, and look at this rip. And this, corn prices are now up. This is just using the ETF. It's probably going to understate the actual returns in the futures. That's almost 40% run since August. And okay, what is different this time around? Okay, we've been in a, as I said, corn and most of these ag commodities have been in bear market for bear market for a while, and we've had bear market rallies, and we've caught a lot of those bear market rallies. I love trading these commodities, even in a bear market, just like in a bull market in the stock market, like we're in now. I'll trade bear market rallies, or bear market, corrections within a bull market. Just like in a bear market, I love trading, long. You look for these setups, get your whatever percent it is, and then look for the divergent highs and get out or short for the next trend down. So where I'm going with this is we've had all along, let me clear out those lines and turn everything off. All along, for years now, we've had bear market rallies, and they get sold into, right? After a while, they run their course, and then the bear market resumes. And this one looks different. Why does this one look different? Well, number one, the scope of the rally, the intensity of the rally too, especially at this point, and more so, we're taking out, look at your previous reaction highs. All these previous reaction highs have been taken out. Here in these other bear market rallies, you fell shy of most of the previous reaction highs, the rally, and that is typical. In other words, a downtrend is simply a security making a series of lower highs and lower lows. And so there's still work to be done. This is a major reaction high. And you want to look at futures too. These ETNs don't do a perfect job of tracking, but if and when corn, and it's not going to continue this forever, there'll be a correction here. We've gone nearly parabolic, so I wouldn't be chasing it right now, but these are the things to look for when these reaction highs start getting taken out. So why am I talking about commodities when I was just talking about bonds? Well, this is inflationary. The Fed has had a green light. They've been able to keep rates, pedal to the metal, because of low average inflation. Inflation's been running very low because, in large extent, commodity prices have been falling. But what do we know over last year? Well, after COVID, housing prices shot up. The housing market's been strong. Hard commodities, soft commodities alike have been rallying. Oil has been rallying hard since, up huge since the March lows. Timber prices have shot up. We got a sell signal recently. That's one I'll cover that in another video. But when I go back here, again, these had very bullish technical postures at those lows. It wasn't a random reversal. And it's not just corn. You look at soybeans as well. I mean, this is an explosive rally since April. Soybeans have rallied 50 something, 54% or so. And again, when you look at the chart, look at all these reaction lows that have been taken out now, all the way back to here. I mean, that's where we're at right now. So again, this is more indicative of early bull market action. Is there going to be a correction soon? Sure, but there's been corrections along the way. And again, it wasn't random. This is when identified the bottom, gave a buy signal right there on the breakout of this little wedge, that downtrend line following that divergent low, and soybeans haven't looked back. They went on to hit every one of these intermediate targets and have just been ripping higher since. So inflation is the common theme here, and that is to loop back to the Treasury bonds. I covered TYX. TNX is the 10-year bond, and you can see also a breakout right there. So I'll kind of end it here. TNX has the primary trend line way up here. If this is going to be a breakout or a fake out, a false breakout, then you want to see a drop back down below this trend line right here and back below that 969 level. As of now, the breakout's intact. Like I said, I'm taking with a grain of salt, but it's pretty impulsive. I've been sharing the futures with you guys. ZB, this is a 2-hour candlestick chart, so 6 months of price action, and there's that symmetrical triangle pattern. What I said recently could break either way. I said if the stock market corrects, it's probably going to break this way. I was leaning towards that, but I did say it can certainly break either way. And the one thing I said about it is it's like a coiled spring when you get in these triangle patterns, building energy. And so it is anything but mere coincidence that you see the biggest drop, in fact, all this, in months in Treasury bonds. It's because we broke that triangle pattern. So there's that energy in that coiled spring. And this has been, again, one of the biggest moves. That's the 30-year bond dropping. And here is ZN right there, 30-year bond, 10-year bond, I'm sorry, ZN, same thing. There's your triangle pattern, there's a breakdown, impulsive drop. Okay, so either the smart money is really smart and they're selling bonds, they have no fear, they're putting money into stocks right now, or they made a mistake here, and if the stock market does break down, here's where your most likely scenario, you're going to see a back test, at minimum a back test of the triangle pattern. And I'll tell you, since I'm favoring this, whether it happens this week or not, this is my preferred scenario. So there was a short trade to be made on that breakdown there. And look, if you're in it, it's a powerful breakdown in bonds. You can, just lower your stops if you want to let it run. If you think but you think bonds are going to continue to fall, yields are going to continue to rise. But if you get those sell signals in the stock market, I think you'll get a quick reversal in bonds, at the very least a back test. And there's certainly the possibility that it could prove to be a big whipsaw signal, and fewer things in the market are more powerful than that, a false breakdown, because you would see institutions scrambling to turn around and put money back into bonds to reduce their equity exposure. So these are things to watch for going forward. Finally, give you an update on gold. The last update I made in the post the other day called the Everything Setup. Somebody asked about gold. Hey, Randy, what are your thoughts on gold? I didn't cover it in that update because it wasn't relevant to the stock market and everything there, including Treasury bonds and all that, and the dollar. But what I did cover is, my outlook on the dollar and the euro in particular. The euro has not triggered that breakdown. We need to see that happen for the dollar to start to rally. So here's the euro. These are the E7 euro futures hourly. When we were there, we were close. We're right here. There's the primary uptrend line. And again, I've covered this. It's no coincidence. The stock market had a major reaction low on November 2nd. And that's where this trend line starts. So did the euro. The euro has been trading positively correlated, highly correlated with the stock market, meaning both going up. And the dollar, of course, is inversely correlated. So what we need to see if and when we get a breakdown here, and I think it's just a matter of time. We have a nice, beautiful bearish rising wedge pattern. We have negative divergence building here on these indicators. You get a breakdown here, and that will be bearish for the stock market and most likely bearish for gold. And going back to that last update, and then we'll wrap this video up. Where was I? Okay, so this was the other day. So I said gold futures are at resistance while overbought on this 60-minute chart. And you can see the overbought readings. And so I'm figuring a pullback to this trend line is likely. Anytime you have a well-defined uptrend line like this, you get away from the trend line, you come back and visit it from time to time. And you get too far away from it, you come back and visit. In fact, you could almost look like a price channel here. It's contracting a little, and then you come back and visit. So that was just the other day. Where was it? Somewhere on here. These charts are usually time stamped. Oh, well, whatever. I don't see the timestamp on that one. All right, let me just show you the chart today. That was, I think, 2 days ago. And GC, there it is. Oh, there it is. Target hit. Earlier today, it wasn't before I started the video. That's it. So just like here, you put in a little divergent high. Boom. So you don't stay too long to the party. When you start seeing these divergences form and you start seeing gold at overbought conditions, like I mentioned the other day, right there, that's it. So you usually get overbought, and what tends to happen, it's not overbought. I always say overbought is not a sell signal, but it's an indication there's limited upside at that point. And what you usually get then is a divergent high. You continue to push up in price, and then you get that negative divergence. Look at that. Boom, boom, boom. You had it here, negative divergence, overbought, boom, correction. Where did the correction end? Well, with positive divergence. And so there it is. Was the case I laid out the other day. You could either, exited your gold longs or put a stop there or shorted it, and here's where you want to cover. You're at trend line. That was my pullback target. We could certainly go lower, especially if the euro breaks down what I just covered. But from here, I expect a reaction. And then if we do break the trend line, that's where you want to have, you could either short again or exit your longs if you didn't do so already. But as of now, like I said, odds favor, I think, a reaction there. There's also some horizontal price support. I should add that right there. So we're at double support right now on gold. So hopefully, if you caught that post, that you were able to capitalize on this pullback, or at least sidestep some give back in profits. Okay, long video, ended up being longer than the previous one, which I scrapped. I know I threw a lot out at you, but that's where I think we're at. Like I said, it's all priced into the charts. There's a lot there that say a correction is going to come, and it's probably going to be a pretty big one. We just need those sell signals on the equity markets, on the daily time frames, and it would also help to see treasuries reverse. Although, like I said, they may be, sometimes treasuries will give you predictive value. They start making a move like the VIX was, like I showed you, ahead of a correction. And so sometimes you can get a heads up there, and sometimes they don't. And that's when you get usually the biggest drops, because like I said, the institutions are caught off guard, and then they scramble. They start selling equities and buying treasuries to hedge their minimize their losses. All right, we're going to wrap it up here, and let me get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.